Hello, my name is Natalie.
I'm Ines.
I'm Sandrine.
And I'm Jonathan. We are Team 8.2 here to present our REVSIM for Fisherman's Hotel.
Now that we've introduced to you our management team, we're going to take a deep look at our performance over the last 12 months. Then we are going to analyze it and present to you our findings. Finally, we're going to conclude by giving you our recommendations for the future. But first, we are going to give you a quick preview of the background of our hotel. Our hotel is 8 years old and is a full-service, 4-star hotel ideally located in the city center on a waterfront site. It is a business hotel, with highest occupancy being weekdays. It has got 250 rooms that include 200 standard and 50 premium. The hotel also has a restaurant of 125 seats with an adjoining bar and lounge section with 50 seats. The hotel also has a 2,000 square feet conference event space with flexible configurations that can fit up to 200 people. There is an exercise room with a lovely view on the bay, which is accessible to guests 24/7. There is also a pool as well as an outdoor recreation area. We also have a lobby bar and kiosk. We offer many different kinds of services that include free parking, digital and international telephone service, guest laundry, and dry cleaning.
So now to positioning. We service mainly business customers. This explains why our demand during the weekdays was higher. But during the summer months, we also worked with leisure customers. We mostly targeted transients, but our facilities also allowed us to accommodate groups, as we did in May and November. Our budget didn't allow us to expand into a business center. Thus, we had similar facilities as our competitors. Nevertheless, we tried to differentiate ourselves with value-based strategy, offering higher quality than our competitive set, competition-based strategy, basing pricing decisions on the competitive set. Our facilities included, amongst others, an executive room, a pool. We invested in a lobby kiosk and a lobby bar. These allowed us to generate more ancillary revenue. Our services included free parking, guest laundry and dry cleaning, room service, in-room digital entertainment, and we expanded them over the year. On the price-value map, we can see that the correlation between the price-value has frequently changed over the year. This is why, because we constantly changed our price strategy and we improved our services and facilities throughout the year. Now to our pricing strategy. During the first month, we didn't apply any rates, thus we didn't generate any revenue from the rooms. Starting from the second month, we set the prices just a bit over the lowest competitor, but this proved to be a very unattractive market-based strategy. Next, we adapted our prices just under the average market price. Starting from June then, we applied a value-based pricing since our services and quality also improved.
So now we will discuss the second part of our presentation, our performance review. Our total revenue was roughly 10,400,000 with a total cost of approximately 9,400,000. And our profit was 1,038,554. Our overall occupancy this year was 57.43% with an ADR of $181. Now let's have a look at our overall performance of the year. Room market share 11.19%, which is slightly under the average market share, shows a clear augmentation since we started with 0% after our era. As mentioned before, our net profit was $1,038,544. However, we believe that we could have done better if we didn't have the rate issue at the beginning. The ROE compares the net profit to the funds invested by the owner, meaning that for every dollar invested, we received $3.97. We are very pleased with our guest satisfaction, and our next year's goal will definitely be to invest in facilities, refurbishments, and services as the quality depreciated at the end of the year. About our revenue and profit now. Our revenues are increasing throughout the year, especially in the third quarter. August having the highest profits as it is during high season. If we compare the revenues made in the beginning of the year and the ones made at the end of the year, we noticed a big improvement. In fact, we went from a negative profit in January to a positive one in December. Now, about our occupancy. As we can see on the slide, our hotel's occupancy exceeded the external occupancy of the competitive set in the first, second, and third quarter, with a peak occupancy of 76.48 in August, and the lowest one being 0% in January. And now our ADR. When we look at our average daily rate performance, we notice that it was rather low compared to our competitive set. Only in quarter 3 does our ADR show its best result. However, it is still under the competition. Our ADR exceeded the other hotels only during the last operating month with an index of 101.47, and the lowest being in January, obviously, as it was inexistent. Now we're going to talk about our quarterly report for our RevPAR. Fortunately enough, our RevPAR exceeded the competitive set twice in the third and fourth quarters, with our top index being November with 107.57 and the lowest again in January with 0. Now I'm going to talk about the request for proposal, RFPs. We received 4 group proposals every quarter, all of them being guest rooms only. To decide on the room rate offer, we observed the large group trends, average rates of last year, and the economical situation. We also forecasted the impact on total revenue of getting the group in comparison to the lost transient guest revenue. Additionally, as the 4 RFPs were only guest rooms, no ancillary contribution could be added to our revenue. 2 of our offers got accepted. The rate of $70 for the first offer in May was a bit low, but the additional 175 rooms obtained really helped us to reinforce our presence. The second offer at $75 had to be shared with a fellow competitor. Therefore, we gained 50 additional rooms. That really helped us staying competitive during this low demand period.
Thirdly, as for the analysis and findings, in the first quarter we focused our attention on investing in maintaining the facilities that we considered most important for our target market: premium and standard guest rooms, front desk, associate facilities, the lounge, etc. In the second quarter, we shifted our attention more in line with our value-based strategy by investing in additional services such as our environment program, restaurant, providing free parking, etc. Then the third quarter came along. As it was the peak season, we chose to invest in the renovation of soft goods and services to retain the interest of our returning business clientele. Here we invested in meeting rooms, associate facilities, public areas, the front desk, parking, and further our environmental program. In the last quarter of the year, we maintained a constant investment in meeting rooms and the front desk. We chose not to invest in December because we highly recommend the hotel invest more fully in deeper renovation, which we consider necessary, as will be discussed later. On another level, we have additionally chosen to invest in adding more services to go with our value-based differentiation strategy. By adding services such as foreign exchange and transportation van in March, in-room guest internet, minibar and express check-in check-out in May, and concierge, turn-down services and music and entertainment in June. Now I'm going to talk about the weekends and the weekdays. In the first quarter, the occupancy rate was higher for weekends than weekdays, which we should have used as an opportunity to increase prices because we realized later that demand was high enough so that we could afford to increase prices and still maintain a good enough occupancy rate. During the second quarter, the rate for weekends was lower at the beginning and then increased to match that of weekdays in the second month of the quarter. It then goes up again as we approach the peak season, starting in summer. The third quarter being the peak season, the occupancy rate on weekends remains well above that on weekdays, to then decrease drastically in the last quarter of the year.
Now let's take a look at how we managed our distribution channels. On this graph, we can see the contribution of our various market segments. Indeed, we have a little over 31% from discounted, a little under 30% from transients, and our biggest contribution comes from groups, with almost 40%. All of this confirms what has been said before in the performance evaluation. Now let's talk about the correlation between investments in marketing and the total revenue made. As we can see here, the more we invested in marketing, the more revenue we made, especially in the summer months. In the beginning, we didn't invest enough. Later, we realized that we should have invested up to 6% of our revenue in marketing. Therefore, we increased a lot our marketing expenses in June and then adapted accordingly to our forecast. Here, we can see that there is no rate parity in order to target more direct bookings. We did that since it is the direct channel that costs the least to our hotel. Our second biggest investment was in OTAs. However, since GDS brought more income, that we can see right here, we realized we should have targeted GDS bookings more intensively.
And now for our recommendations. On the short term, we would like to refocus our distribution channel strategy by investing more in GDS as it brought us the second most revenue after the direct channels, therefore gaining market share and improving occupancy rate. Also, now that we have a better understanding of the market customer, booking patterns, and our hotel performance, we can redefine our trigger points and rates since the original decision was based on existing occupancy rates and teammate judgments. We would also like to keep adjusting prices and marketing expenditure, relying on the market forecast. Another recommendation would be to analyze forecasted demand for weekdays, weekends more thoroughly and set prices accordingly, as we didn't increase prices on weekends even though demand was higher. In the future, we would like to offer more attractive prices to large groups as they were our second strongest target market. On the long term, with sufficient funds, we would plan to build a business center to attract more business customers, implement a constant refurbishment of rooms, and expand meeting rooms and restaurants. On the other hand, with lower funds, we would encourage a contract with MICE and GDS to attract more groups and build long-term relationships with these groups. Thank you so much for listening.